Right. Typically, this represents currency. So, country will have something like this. This is just an abbreviation, but there's a formula to each of these stuffs. And let's get into that right now. You see, the first two letters here represents the country or region, and the last letter here represents the currency. So let's do the math now. GBP. GB here represents Great Britain. That's the country or region. The P represents the currency. US represents United States. That's the country or region. The D here represents dollar. Okay. The AU represents Australia and the D represents dollar. The NG represents Nigeria and the N represents Naira. The CA represents Canadian, that's the country or region, and the D represents dollar. So I think you understand this already. But when it comes to Forex, you will likely see things like this. When it comes to Forex, you will likely see things like GBP slash USD, right? You might have seen things like the GBP slash USD, AUD slash CAD, right? Euro slash USD, USD CAD, and we have GBP slash JPY. So the list goes on and on. So obviously you've come across either of these stuff through your Forex journey. Forex is just an abbreviation for foreign exchange. So in order to make money as a trader, we make money from the fluctuation in value of different currencies. Great Britain pound is a currency of a particular region, right? The USD is the currency of a particular region. So the combination of this is what we make money from. That is what we mean by currency pair. Just the combination of two country currency in order to make money from the value fluctuation. All right, so let's move further. Currency pairs are categorized into three levels, and these are based on the power. Now, let me write that down. We have the first one here is the major pairs. The second is the minor pairs. And the third is exotic pairs. So we have the major pairs, we have the minor pairs, and we have the exotic pairs. This is the strongest, followed by this, and followed by this. Now let's explain them one after the other. Let's start from the major pairs. But before I do that, let me just write this quickly. So let's list out the country currency we're working with in Forex. Typically, we have the USD, we have the GBP, we have the EUR, we have the CAD, we have the JPY, we have NZD, we have all already, and we have AUD. Where can I write that? We have AUD. Let me just minimize this. NZD. And we have AUD. Right? So let's start with the major pairs. So we have GBP slash USD. We have USD CAD. We have USD slash JPY. We have Euro slash USD. We have AUD slash USD. We have NZD slash USD. So typically, major pairs involves most traded currencies globally. And if you look at these examples on the board, there is a similarity between each of them. You see US dollar pegged with each of these pairs. Okay, so typically when it comes to major pair, it's comprised of the United States dollar and one of the most traded pairs. These are the most traded currencies around the globe, right? These are the most traded currency pairs. So when you combine the United States dollar with either of these pairs, you have the major pairs. So let's move to the minor pairs ASAP. We have the minor pairs. In order to get your minor pairs, you have to combine all the other most traded currencies without the United States dollar. That's just the difference between the major pair and the minor pair. Let me write them on the board. Euro slash GBP. We have CAD JPY. We have GBP slash AUD. We have CAD slash NZD, and it goes on like that. So that's all about the minor pairs. I hope you understand that. If you have any question, leave that in the comments of the video. So let's move to the exotic pairs very fast. So the minor pairs, you just need to combine either of these currencies without the United States dollar. So let's move to the exotic pairs. You see, before we get into this, whenever you see this word exotic pairs, this word sound very interesting, right? Exotic, like it's very sharp, very sweet. It's like something you want to lick. See, whenever you see this stuff, run. Look at this. Till the end of this video, just keep looking at this stuff. You see, run. Whenever you see exotic pairs, run for your life. You see, the moment you place a trade on these currencies, they might blow your account. This involve the United States dollar and other emerging economy currencies. Do you understand? It involves the United States dollar and any other emerging economy currency. So what are the emerging economy? You can think of them. We have the Naira, we have the Ghana cedis. You see all those countries. So let's just list few. So I have the USD slash NGN. When you're writing currencies, it needs to be in capital letter. So you have to put that at the back of your mind as well. So you have the USD GHC, USD TRY. So you see, when you're trading exotic pairs, you know the main purpose of forex trading is to grab those liquidity, is to make money from the fluctuation in the currencies, right? So this market has low volume of liquidity. It has low liquidity. There's not much participants in these currencies compared to the United States dollar, Great Britain pound. You know, these are strong currencies. So there are a lot of people that are actually trading these pairs. So you want to be where the big waves are moving. As a trader, just follow the trend. So that is all about the exotic pairs. So let's move further. We are done with this segment already. So whenever you see this, now we are moving to the exchange rate, right? But before we go into that, let me write this down so you remember. So we have the base and the quote currency. Base and quote. Base and quote. Okay? You have the base and quote. So whenever you see things like this, GBP slash USD. Just remember this word. The US dollar is the quote currency, while the GBP is the base currency. Any currency you see at the second is the quote currency. The first currency is the base currency. But we'll talk more on this in a second. Let's move to exchange rate. So let's go to exchange rate. So typically, as a trader, you already know we make money from value fluctuation. So whenever you go to the bank, this is a common scenario. There is a box in the bank, something like this. You find a box in the bank and you see currency pairs. You might see GBP slash USD. Now you see a number here. You see USD slash NGN and you see a number there. You see USD GHC and you see number there. You have USD card and you see a number there. This number here is the exchange rate. So when you check this board, you see these numbers. This number are the exchange rate. And what this means is, let's use GBP USD, GBP slash USD. For instance, this simply means you need 1.20 United States dollar in order to buy one great rate in pound. This is the quote. Remember, I said the quote currencies, the quote, and this is the what? The base currency. So what this means is the quote currency, you need 1.20 United States dollar in order to buy one Great Britain pound. So any number you see here, it means you need this particular number in order to buy this. So any number you see here, it means you need that particular number of naira in order to buy one United States dollar. Imagine you're trying to leave the country, right? When you're trying to jet off the country, you go to an exchange booth with your local country currencies and you exchange your currency for the currency of the country you're going into in order to buy things there, right? They change your currency for you. They exchange your currency by the help of the exchange rate. So when you go to the exchange booth with your dollar, so you need 1.20 dollar in order to buy 1 pound. Whenever you do this, you've participated in foreign exchange markets. Now, when you go to the bank, you often see that this stuff always change. You might see 1.20, 1.21, 1. You see it goes up. You might see it at 1.18, 1.19. This keep fluctuating. So why does this move up and down? You see, the exchange rate is impacted through certain stuffs like the supply and demand of that particular currency, geopolitical events, right? Economic data. So when there is election, when things like that happens, when there is war. See, when I started Forex trading, I shared this example in our previous video. It was due to the fact that there was so many adverts related to Forex at that moment. There were so many adverts. It was during the lockdown, during that Corona. People were actually home. I was also sitting on my hand, but this ad kept popping up on my phone. And I still see people making money. So I got curious and decided to Google what trading was all about. That was when I discovered, you see, traders make money whenever there's a global event. So all these events are what impact the currency of a particular country. Do you understand that? So just move to your MetaTrader. So we are done with this. So these move to your, we're still explaining the exchange rate, but I want you guys to do something really fast. Now move to your MetaTrader 5. If you have it already installed on your phone, move to your MetaTrader 5. At the right hand side here, at the right hand side here, at the top of your MetaTrader 5, let's assume this is your MetaTrader 5 screen. And this market has been moving. You see your market moving like this, right? Right? And you see your market moving like this. Good. Right? Now, this is the particular zone where this market is at the moment. The market is currently at this particular zone. You see two straight lines. Check it very well. You see two straight line like this, two straight line like this. So the market is currently at this particular line. So this will be your ask and this will be your bid. So in Forex, there are always two prices for each currency. So we are still working with GBP slash USD. So there's always two prices for each currency. We have the bid price and the ask price. So you understand more of this. Now, on this right hand side, you have this box here. Here you have your buy, and here you have your sell. And if you check that box, you see a number that is fluctuating. What this typically means is if USD is your quote currency and GBP is your base currency, it means that whenever you click the buy button here, you're automatically buying Great Britain pound. Try and open a demo account and practice this now. Don't do this on your live account. Just this for practice alone. Move to your demo account, and whenever you click the buy button, automatically you're buying Great Britain pound. Whenever you click the sell button, automatically you are selling the Great Britain pound and you're buying dollar because you've paired these two country currencies together. So when you click the buy button, you've bought GBP. And when you click the sell, you sold GBP and you bought United States dollar. So whenever you see a country currency going up, that's whenever your chart is moving up like this. This, let's assume this is GBP USD chart. So this market has been gaining strength over US dollar. So the economy of Great Britain is gaining strength over the United States dollar. So when one currency goes up, it shows that that currency has strength. And when the value of that currency goes down, you already guessed it. The other currency is gaining strength at that particular moment. So let's go back to our ask and our bid price. You see, whenever you click the buy button, now you see this candle, this market is currently on this line, right? It has passed this other line. This other line is just open line. Here you have your price 1.0007 and you have something like that. You have numbers here, right? You have all those numbers there. So this line indicates the particular price where this market is at the moment. So whenever you click the buy button, if you hit this buy button, your broker will not buy the market for you at this particular rate where the market is. No. Rather, the broker will place the trade for you at the bid price. If you click buy here, instead of your broker to place the trade for you on this ask price, they will rather place the trade for you on the bid price. And whenever you click sell, I'll show you the sell scenario. So why does this happen? You see the line between the distance between these two price, that's the ask price and the bid price, just this little price between the two of them. You see the value fluctuation. Even your brokers are making money from value fluctuation. So you see the difference between these two lines is what we call spread. It's called spread. Let me write down spread. Right? It's spread. Look at it. Spread. This typically represents the price between the ask and the bid price. So that's where your broker make money. So as a trader, you need to look for a regulated broker. You need to look for good brokers that actually will have tight spread. So you need a tight spread in order to make money from the financial market. So they are not actually cheating you here. It's just their own way of making money. So just go to your MetaTrader 5 on your demo account. Don't go to your live account. The moment you place a trade on your demo account, you see minus. If you check your equity, straight up, you see minus. You're already in drawdown. Your balance still remains the same. I mean your equity. You see a negative equity already. You've already paid for your spread. Immediately you click the buy button or the sell button, you've already paid for spread. So you've already paid your broker. That is the minus. So that's where you need a good broker. So let's change this scenario upside down. Let's assume you're on a sell pattern. So the market has been in sales, right? So you have those two lines. So this little distance is your commission. That is the amount your broker charge you in order to place a trade in Forex. So that is that about foreign exchange. So when I started Forex, I didn't know good broker then. So I stumbled on some terrible brokers that they increase spread. So you need to be careful with that. And also you need to be careful whenever there's a fundamental coming out in the financial market. You see, the whole of forex market is moved by fundamental factors, supply and demand, economic events. So you see, whenever these economic events are happening, you need to know what you're doing in the financial markets because your broker might increase spread for you. So that's why you need a good broker. So that is the end of this particular video, and that's a wrap on today's video. If you gain value from this video, make sure to hit the like button, subscribe to the channel for future content, and until next time, happy trading, guys. And before we go, if this is your first time of coming across this video, this is a course already. This is a full course on forex trading. I'll be taking you from the basic of forex trading to the brilliance of forex trading. So by the end of this particular course, you should start making money from the financial market. So happy trading, guys, and see you next time. Cheers.